If you guys are anything like me and you're in tune with a lot of the different financial situations going on lately, or you look through YouTube or you've been finding articles online with tons of people just saying that the next recession is amongst us, the 2020 recession is coming, or the recession is here, there are just so many things out there right now that are boasting that these people can claim they know when the next recession is. But in fact, no one really does know when the next recession is going to hit. And in this video today, I'm going to be talking about market timing. So first off, if you guys are new to my channel, haven't really been here before, what I do on this channel is talk a lot about stocks, finance, the market in general with my tips, tricks, and insight into the stock market. So if you are looking to increase your portfolio size, then make sure that you subscribe to the channel and turn on that bell notification if you want to be alerted when the videos come out. So like you saw in the intro of this video, there are just so many articles out there that are being published and really highlighted about all of these different recession scares going on, or the market is going to turn bear and go negative for however long. But basically, I just want to mention that people have been doing this for a number of years. It's not like this is a new thing, but people are just more in panic mode now. And what you are going to realize is that those articles that people make and post, if that doesn't go their way, then those articles seem to disappear online. So if somebody was predicting that the recession was going to happen in 2018 and it didn't happen, they likely would delete that post that they made and maybe shift it out a year and hope that it just gets swept under the rug so no one really knew what they were predicting or not. And then eventually, as they keep pushing it out, they finally get it right, and then they highlight that and they make it seem like they have the ability to predict when the market's going to do everything, and it's going to convince some of the beginning newer investors to follow along with some of their teachings. But in reality, it's not the best thing that you should be doing. So it's been proven time and time again that when you're ready to invest, it's almost impossible to time the market, and it's a better strategy to ease yourself into the investments over time and just keep making incremental payments over that set period of time. For example, in 2009, when the housing market completely tanked, there were some individuals who were buying houses around this time when the market was super low at the lowest point it could possibly be at. And then in 2015, they said that the prices of housing was ridiculously high. They could have bought into more units, but they decided not to. And then the housing prices from that point still haven't gone down to this day. So it just is there to show you there's a lot of money to be made. And if you just hold off on your investing, then it's going to hurt you more in the long run if it's not done correctly. Now, there are definitely some indicators out there that show that a recession is coming, and I've talked about that in previous videos, but I'm not really here trying to predict when it's going to happen. I'm just more structuring my portfolio in a safer way, so that way when a recession does occur, whether it happens now, 2 years from now, 10 years from now, whenever it happens, that my portfolio is ready to perform under the harsh circumstances that we might see. Now, there are a number of ways that you can minimize the damage from recessions in your portfolio, and one of my favorite is investing in ETFs. So Vanguard has some really good low-cost ETFs that you can get into. VOO is one that tracks the S&P 500. That's a great index for you to follow. Also, you can start investing a little bit more in bonds. Shift your portfolio ratio to hold a little bit more bonds than stocks, or however you want to handle it. Right now, I'm more invested in stocks just because I'm younger and I have all of that time to grow the portfolio, so any minor setbacks won't really affect me that much in the long run. But basically, that's the huge emphasis of this, is setting your portfolio for the long run and not really making, day trades if you're not doing the proper research behind it. It's a lot harder than you think. I mean, when I first started investing, and I think everybody goes through this kind of phase, is they think that they know and can beat the market and just make day trades and trade penny stocks and do extremely well without having the proper information or knowledge to back it. So I've started to shift my portfolio away from that and really structure it in a much healthier way. No matter what the market looks like. Obviously if the market's doing well, it's up 10% and your portfolio is up around 10%, or you're even higher than that, then you're doing great. But I mean, there's going to be a recession at some point, and say the market's down a total of 20%. Hopefully if you structure your portfolio right, you're not going to be down that much. Say you might be down 12%. I mean, you'll still be down likely because there's a recession happening, but it's just going to mitigate that damage that you would receive. So another focus for me in my investing style to help set up this portfolio is to invest more in healthy dividend stocks. What I primarily look for is dividend stock companies that have increased their dividend payments for the past 25 years. In that case, they are falling within the dividend aristocrat family. So you're going to be able to get a lot of dividend payments from these companies even when there is a downturn in the market. Because like I said, 25 years, that's taking into account the 2009 recession. So they were still increasing their dividends when that was happening. So you know that you're going to be getting these dividend payments. And then what I'm doing with those dividend payments is just reinvesting them right back into the portfolio. So dividends are huge for me, and they're really going to help accelerate the growth of my portfolio. So if there's anything I want you guys to take away from this video, it's that nobody can really predict what's going to happen in the market. And then on the other hand, you should also be trying to structure your portfolio as best as possible, so that way when a recession does hit, you are prepared and your portfolio is not going to take as much damage. If you guys enjoyed the content today and you made it this far, please leave a like on the video and subscribe if you haven't already done so. Thanks for watching.